Hello, everyone. Thank you so much for being here today, and thank you for making the choice to invest in yourself and your practice by joining today's financial planning session. Today is all about learning how to easily execute strategies related to helping your clients' tax efficiency. Today, we are going to be talking about how you can provide better tax planning advice and improve your clients' tax efficiency. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague, Lee Martinson, Snap's Customer Success Manager, who will provide today's demonstration and run the Q&A.
Hi, everyone. I'm excited for today's session. Thanks for joining.
Thanks, Lee. So I'd like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your Q&A tab? This is exactly how you'll send any questions you have throughout the session. I'll be using the chat tab, which is a way we can send public messages. But to message us directly, please use the Q&A tab. Wonderful. I can see those coming in. Thank you so much. Glad to know that you can hear and see everything that is going on. So, Lee and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. Perfect. Okay. So, for those of you here today who are not already using Snap projections. Some of you may not be overly familiar with us. Snap is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you want to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third party software review site, you will find advisors saying things like none of their clients retire without a SNAP projection and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. We are thrilled to share that Snap Projections financial planning software is now fully available in French. We are also now providing customer support and product demonstrations with a French language team member. As we move into the case study, we're going to be building out multiple scenarios that we can compare and optimize. When it comes to focusing on tax efficiencies, we're going to be exploring some key areas for our case study couple who are planning to retire in just 5 years. They're wondering if they're on track for retirement and if there are any changes they can make now to improve the tax efficiency of their financial picture. So, what you're going to see here in just a few minutes when I hand this over to Lee is how we can quickly build multiple plans, compare them, and then ultimately use this functionality to highlight the net difference between where we started and where we're going. This is how you, as the advisor, can not only improve your client's outcome, but easily demonstrate the value of working together. This is a highly flexible module that allows you to pick which metrics you wish to compare and highlight. It allows you to change the timeline of your comparisons, and you can visually compare metrics with additional charts. In this case, two of the key areas we want to compare as we build multiple scenarios will be the lifetime taxes payable as well as the estate taxes payable. Before we get into the case study, I just want to make something clear. This is a more advanced webinar than what we typically try to fit into a 1 hour session. The reason we're covering this content today is because tax planning has been one of the main votes when I've asked you all on previous sessions what you'd like to learn about next time. With Snap, we can be quick and simple, or we can conduct comprehensive planning. You can sit down with a client or a prospect, enter a few data points, and create basic projections that are highly valuable within 5 minutes. We have plenty of previously recorded sessions on our YouTube page for anyone who would like to see something more basic after this. Just let me know if you'd like me to send you out something. Today, we are not going to be keeping it simple, and we are going to be getting into some pretty comprehensive planning strategies. So, really excited to bring everybody something different today. So, let's get to it. We are going to be building 3 scenarios this hour. We'll start with the as is base plan, and we will work to optimize first with the default strategies from the software. And then we will get into some more advanced planning strategies with our third scenario. We will then be able to compare the scenarios, plus create a one-page financial plan summary report our clients will truly understand. So I'll get Lee to take over and log into Snap.
Okay, thanks so much, Alex. Let me get my screen sharing going here. All right, so here we are at Snap Projections homepage, and this is where you're going to start to log in to Snap. So up at the top, we have our login option, and I've actually already logged in. So when I click login, it's going to take me right to the client list. So Snap is a web-based platform, and that's going to allow you to access your account from any Chrome browser on any computer without the need for downloading anything. So you'll just start from that homepage, log in, and you will have the option to put your username, password, and also an option for multi-factor authentication if you wish. So here on the clients page, I can see all of the previous clients that I've created, and I can also create a new one. I also have the option, if I want to hide all my clients that exist right now. These are all just test clients, so that's fine. But let's go ahead and add a new client. So we're taken right away just to our scenario setup. And here we have many different pages that we're going to be able to enter data on. And as we go, things will be saved automatically, and I can click the next button to get to the next page or keep using my navigation bar on the left. So today's clients, as Alex mentioned, are a couple. So we have Hannah and Ruben Sharp. So I'm going to enter Hannah first. And she was born in 1970 and living in Ontario. And we'll add her spouse here. So this is for Ruben. And again, 1970. And we'll move on to the next page. Okay, under the general page, we can set their retirement ages to age 60 for both of them. We're going to show the projections up until age 100 and also start the projections as of 2025. We'll be using the default inflation rates, which are from FP Canada's long-term projection assumption guidelines. Up at the top here, there's notes about more details about those guidelines. And that's the guidelines for this year, 2025, 2.1%. And then I've also reduced their cash, fixed income, and equity guidelines by management fees so that we have the net return assumption. Note that defaults can be saved for your own settings as well. Okay, to the next page here. What is their combined annual expenses after tax that they want to be spending in retirement? So for this couple, they've told us that they'd like to spend $108,000 in retirement. Now, I realize that you may not know what your couple wants to spend in retirement, and that's fine because Snap is so flexible. You can either enter an amount here, or we could keep it at 0. And then once we get out to the planning page where we'll be spending most of our time today, we can enter it there, or we can run a sustainable scenario and have Snap generate for us what the maximum spending could be in retirement. So next we'll add an expense. Note also that we have these little question marks on the page, and this is going to give you more detail about the different options and what actually you should be entering here. So travel, this is going to be in the first maybe 15 years of retirement, $15,000 a year. It's a joint expense indexed with inflation from let's go from age 60 to 74. It's going to be every year, and we are going to highlight that in our chart. So next we have the renovation expense. This is going to be when they first retire, $100,000. And we won't index this one. So I'm just going to say it's 0% inflation. And it's going to happen just at the age of 61. So only for that 1 year. And again, we can highlight that as well. So next we come to the income page. So for the employment income, you can note that we're currently looking at Hannah. So at the top we have Hannah and we have Ruben. So I'm currently on Hannah's page and I can enter the amount of her employment income. So this is $130,000 a year. And we will index this to inflation. And so to do that, I can just backspace over the 0% and it fills in for me what my general inflation is so that if I was to make an update back on the general page to inflation, this would automatically follow whatever that value is. So we have our employment income. We have that it is taxable. It is RSP eligible. It was already filled in for me starting from the first year. So I don't need to fill in a from age, but it's going to her last year before she retires, which is age 59 is the last year of her income. I could adjust that, but right now we're just going to leave it as the end of the year where she turns 59. Okay, so that is it for her employment income, but she also has a pension. So this is a defined benefit pension plan. This is from a previous employer starting at age 60 for $45,000 and survivor benefit of 60% indexed at 1%. From age 65 is going to drop down when the bridge benefit ends to $38,000. And again, the same other information. So next, let's look at Ruben. So Ruben's employment income is going to be $120,000 and also indexed to inflation. And it's all the rest set up for me here. So next, we're already on to the assets.
Oh, Lee,
So
sorry, I think you had an extra zero there.
is he making too much money? Oh,
Yep.
that's my default. Okay, that's better. 120. Well, not better for him, but better for our example. Okay, thanks, Alex. On to the assets. So let's start with Hannah. And for Hannah, we have a uh, default non-registered asset. This is going to be there for all of your new clients. And we add this for you to make sure that there's at least one account that is available for surplus cash to flow into in the projections. So we don't need this for Hannah because we're going to add her own non-registered asset. So I'm just going to say add a financial asset and we'll get going on all of the ones she has. So first is a joint non-registered and the amount here is $300,000 and the type is going to be non-registered. The cost just automatically filled in for me. I'll just keep it at 300,000. It is a joint non-registered asset and it's 100% fixed income. So all of these values here are editable, but they're just taken from my general settings page for those asset rates of return. So next we have her non-registered. That's just her own. So we can just call it her non-reg. And this one is 230,000. And as soon as I select here from the type that it's non-registered, then I can adjust the cost. So this one I will adjust to say it's $70,000. It's not joint, and her asset allocation is going to be 30/70. So continuing to add more assets, non-registered. Next comes her TFSA, and this one is 130,000. And I can just hit a T on my keyboard and it will fill in for me that's a TFSA. So a few little tricks here and there that you can learn as you get more experience with the software. And next is RSP, and this one is 380,000 and RSP, and again 30/70. So that is all for her financial assets, like the actual accounts, but we want to give a bit more information about the settings of these accounts. So along the top of the table, I select TFSA, and her past contribution room has automatically defaulted to $7,000 for 2025, and that's what I'll leave for her. And her RSP also defaults to 18% of that employment income that I entered. But in this case, she actually has more room. So we're going to put in $35,000. So note that 35,000 is just her contribution room that's been unused. And we're not telling it that she's making that contribution. We're just saying that there's enough contribution room if she wished to make contributions. It could be up to that amount in 2025. Okay, so back to just her assets here. Let's go ahead and we'll add the house. So this is a home and the value is 1.2 million. And the initial cost, if I put it in here, it's just for information purposes because what we're going to say for this asset is that it's joint and that there's no capital gain tax associated with it. So it doesn't actually use the cost value in this case, but I can enter it if I wish. We don't have any future purchase or sale ages for this asset. We could put it in if we wanted to, for example, if they want to sell it in retirement, but for now we're going to assume that it just remains part of their final estate. By selecting that it's joint, it will automatically show up on Ruben's page as well. But before we go there, I'm going to go ahead and just copy over some of these assets and we'll make some updates to them. But this is a quick way to just get those assets in Ruben's table. And then I can update the amounts and asset allocation if I want to. So again, so we'll come up to the top here, Ruben, to go to his page. So now we're on Ruben's assets and we have all of these ones listed. The default one I'm going to delete again. And we see the joint one that I added before, a TFSA, which I want to change the value. It's 125,000 for Ruben. And he also has a different asset allocation, which is 40 and 60. And that's not right. See, it popped up to tell me, hey, wait a minute, what are you doing? It's not 60% rate of return. It's 60% asset allocation. And so RSP, next one. So he has actually two RSPs. So we're going to call this one his personal. His personal RSP is going to be 520,000. And it is going to have 40%, 60% as well. And then he also has a group RSP. And the group is 280,000 and it is RSP again and 50%, 50%. So just a quick review here. Got those in right. 40% fixed income, 60% equity, 50-50, and the original joint account. So the last thing for him is what about those contribution rooms? So the 7,000 for his TFSA is fine. And the RSP contribution room, we are going to change to 50,000. And because he has a group RSP, we have this employer matching tab where we can indicate that match to his employment income is 5% employee contribution and 5% employer contribution. And we also see the house because that was joint. And so that's it for their assets. You can see there are a few other ones here. We have got DCPP and FHSA and lots of information in our help section all about different types of accounts. So today, as Alex mentioned, we're just kind of going through quickly to show you what's possible. But you'll see with our other kind of customer success training videos, we go into much more detail. All right, debts. We have a mortgage. And the balance is 120,000. And interest rate is going to be 5%. They are making $1,800 a month payments. It is joint, not tax deductible, and it is going to be linked to their home. Don't use a future start age because this mortgage already exists. And next we have government benefits. So I can make sure which page I'm on again by looking at the top or the blue extra highlighted button. You can see that by default, the the pension, the government benefits are starting at age 60 here for CPP. And that's just because we set his retirement, or sorry, her retirement age to 60. So it, SNAP will just start by default the government benefits at the earliest age of retirement or as early as possible. But in this case, let's change it to 65. And you'll notice that this percent of the maximum is 56, close to 57%. That is the same as the national average. So SNAP doesn't know what their past contributions have been. We're not asking you for that information. So instead, we're requiring that you either enter what the annual amount expected is, or you can assume a percentage. So in this case, we'll assume that Hannah will receive about 85% of the maximum that she'd be entitled to, including enhanced CPP. And then we'll do the same for Ruben. Old age security will default to 100%. So you can adjust that as well, but that is the default is 100%. So for Ruben, we'll also change to 65 and 85% of the maximum. So just by hitting tab or clicking away from those cells, they update the values for me automatically. And government benefits. So that is basically the main things that we're going to be entering for this couple. So in about maybe that was about 10 minutes, we were able to complete the scenario setup for Hannah and Ruben. And there are these other additional pages available. So you could add life insurance, education, so RESPs, there's corporations. We can customize more settings. And one of the things that we'll customize for today is charitable donations. So down here under settings, I've clicked that. And now I have what are the charitable donations that I want to enter. So I'm going to select Hannah here, enable the charitable donations. If she had any past unclaimed donations, I could put that here. Today, I'm just leaving that at 0. And we'll be working on donations right on the planning page. So yeah, now the exciting part, we're going to move to the planning page, which is a key feature here in Snap Projections, kind of sets us apart. It is their clients' lives all on one page. And I'm going to tell you that it does look a little overwhelming the first time you see it, but it's quick to learn. Once you know what you're looking at, it is really intuitive and it's so powerful because you can see everything here on one page. For everything from like left to right, we're going to review just a real quick view right now because I'm going to take you into the individual planning pages in a moment. You can see at the top we have a combined page and then we have one for each spouse. We also have one for corporations if you had a corporation in the plan. We're going to spend a fair bit of time on Hannah and Ruben's individual pages, but first, here we are on the combined page. Think of this as a summary or sort of the main overview. This is where you're going to be reviewing the information, not so much making the edits. But a real quick view from left to right, and we'll go into more detail in Hannah's page, but we can see right now I'm under the base expenses column. So we've got expenses, we've got incomes, including pensions and government benefits. There's our donation section here, any taxes that are owing. There's all their financial assets all summarized for you, the total for them combined. So we have this all types, every single year's projected balance. We have real assets, so their home. We've got debts and what's the total amount that's been borrowed or paid each year. Balances, so the estate balances, net worth balances, and the tax on estate. And you'll notice some of these values are blue. So what does that mean? Well, that means like you can click on them for more information or potentially click on them to get a table. So for example, estate before tax, this is going to give me the final year's estate before tax summary. But other values that are blue, you can see here, blue for travel and renovation. Those were their additional expenses. Those are clickable because we can edit them right here on the planning page. On the combined planning page, remember, it's mainly a summary, so that's why most of these values are black, but you do edit the expense details on a combined planning page. So we'll come back. Here's that 108,000 that we'd entered as their base expenses in retirement. So starting in 2030. So let's go to Hannah's page and dive in a little bit more detail here. So right now we can see these initial values under the base expenses column. These are in italic and they're gray. I can't edit them and they've been calculated for me. So these values came from the details we put in about Hannah's income and expenses and so on in scenario setup, plus things that were calculated for her like taxes. So if we go left to right, we start off at the age and the year of the plan. Then we have the leftover expenses, which are calculated from employment income plus what other income is she getting? That's it right now is employment income in this first year. But we can see that her taxes are going to be based on this 141,000 of taxable income, where again, I have a table that I can look at details about taxable income for every given year. She has some expenses for CPP and EI deductions, her taxes, and keep going along to the right. We've got financial assets. So these are all of her assets, the end of the year balances that are projected based on the rates of return that we entered. Her house, this is half of the house value. So remember we made a joint asset. So her half is 612,600 in the end of the first year. The mortgage, what her half of the mortgage is and her half of the mortgage payments. And then the final estate, assuming that she was to pass away in that year, as well as Ruben. Okay, so we want to make some changes on this page. We want to tell the software that she's planning to make some contributions to her TFSA and RSP. So as I look at Hannah, the TFSA contributions will start off just by clicking the value. So anything blue here or purple. So purple indicates withdrawals, blue indicates contributions. The 0 right now is going to be changed by us to $20,000. I'm copying that down to her retirement age. It's turning yellow to indicate that I've made that input. And 20,000 to her RSP. Again, it's going to turn yellow because I've made that input. I've changed the 0 that was there before. And then next we have the cash charitable donation. She's going to be doing $10,000 a year of cash donations, copied down to the end of the projections. So all of those changes I've entered, you can see that it says the scenario's changed. You need to rerun the scenario to see the updated results. So the calculation to update the page has not been done until I click run scenario. And that's on purpose because we don't want to keep changing numbers on you while you're continuing to make edits. You can make that one calculation change at the end of all of your edits. So by putting in that extra information that she's doing the cash donation plus the TFSA and RSP contributions, note that the $20,000 TFSA contribution I entered has been automatically changed to $7,000 in those first couple of years. So the software, we told it she only had $7,000 of contribution room. So that's all it's letting us put in. So this is going to prevent you from over contributing to TFSAs or RSPs in the plan. The TFSA contribution limit will be assumed to go up with inflation and rounded to the nearest $500. So this is a higher amount in a few years. Looking back at the money that's left over after all of that contributions have been made, it's now less because she's bringing in 130,000, making those donations, also making the additional contributions. So she has less left over for her spending after all of that. All right, we also want to make a change for Ruben. So we'll do that. And then we're going to look at the combined page and in detail what's happening. So for Ruben, we'll do the same TFSA contributions. We'll go to the 20,000 TFSA. And you notice that my mouse is changing from a kind of a hand to a pointer finger when I get over the value. The hand lets me move the page around, and the pointer finger lets me put in contributions here. So that's something to keep in mind when you're just trying to get the ability to enter these contributions. Make sure you see that pointer finger. So 10,000 to the personal RSP. He's also got those group contributions. Those ones are showing up already because we did put them in scenario setup. Run the scenario for Ruben, and the same thing is going to happen for him, that the TFSA will reduce to the maximum allowable, at least what Snap thinks is the maximum allowable, and his RSP contributions are fine. Those stay there. So we're jumping over to combined. Now, this is where we can answer their question of, am I going to be okay? These are the planned contributions that we have. This is how much we want to spend in retirement. This is our additional expenses. How's this going to look? So $108,000 spending in retirement, indexed with inflation, plus additional travel expenses, plus the renovation in that 1 year. And if we scroll down to the bottom, we'll take a quick look and just see that we don't see any pink line, like pink highlighting, which would indicate that they're running into a shortfall. But before I get down to the bottom, I should just review with you what's happening here at the top. So in these years before retirement, before what we call this cash flow management start age, and this is something that will be, once you get involved in Snap, you'll learn all about this. And it's a terrific feature because you can delineate where you want to start entering expenses and have the software make automatic contributions and withdrawals for you versus typically before retirement, we're going to enter those manual contributions, what the clients are planning to do, and then let the software show us how much money is left afterwards. So from left to right, again, we can take a real quick look and just see that we've got those financial assets with those contributions. In retirement, money starts being withdrawn from the non-registered first, then the TFSA, and then the RSP. And we're going to get into more details about that. We had those pensions starting, government benefits starting, additional expenses. The debt was paid off here, just about the second year of retirement. And then scrolling over down to the bottom, we've got, if I highlight here again, about $1.4 million left in all of the assets added together here in the final year. So they're okay. Another way to look at this is in the charts. So I did click that button pretty quick. I'm so used to moving around fast, so let me show you here. It's on the charts button at the above the planning page if you want to take a look. These charts are also in the report, but you can access them quickly here. These are all interactive charts, so we can hit, not hit, but we can just highlight different expenses. So I can hover my mouse over the legend and see different items highlighted, or I can even click each of the items and that removes them from the chart. But that's another option that we could go into if needed. So this chart is showing us the cash outflow. So in all years, they have this base expense as one of their cash outflows. They have additional travel some years. They have renovation that 1 year. They have income taxes they pay, debt payments. The mortgage gets paid off early. They're making contributions to their financial assets. And then the total inflow is equal to the total outflow. So they're in a good position here. We can also show charts in real dollars as well, without inflation. And the second chart is the cash inflow chart. And this one is so helpful for clients when they want to know after they've been working. So in the first few years, it's simple. Where's their money coming from? It's their employment income. But then it gets a little more complicated in retirement where they start adding in their pensions and OAS and CPP. And when should I start taking my registered money? And when should I start taking non-registered and TFSA and so on? So you can hover over all these different items and show them when they start being used in their projections. We also have a line for taxes, and this can show you how it looks for taxes paid every year and if there's any spikes or here we can see like in their early years of retirement, it's very low taxes, and then later it's a bit higher. So that'll help you maybe make some tax optimizations, which is what we're going to be talking about today. Net worth chart, again, this one can be also shown in real dollars. So in the final years, they have the equivalent here. Mostly their real asset is making up a lot of their estate, but a little bit of registered money and a little bit of TFSA money. Okay, so there is also an asset allocation chart for any given year. You can look at that as well. All right, so back to the planning page, and let's think about the main topic of today's webinar. So built-in tax efficiency. Snap has default functionality that's going to help make the plans tax efficient and ready for implementation as soon as you've completed entering the information. And I want to show you that because we can turn off some of those defaults and show you the difference. So if I come back to Hannah's page, we'll see we have a transfer section, and this is for pension splitting. But by default, you can see Snap is splitting about half of her defined benefit pension plan right away. And it changes over time because it pays attention to each individual's taxable income and it's trying to equalize those. It wants to reduce their total taxes paid in each year by equalizing their taxable income. So if we turn that off just by selecting suspend pension income splitting in that header, then we're going to see just dashes through pension income splitting. So it's no longer active. If I switch to Ruben's page, there is another tax optimization that Snap does that I can point out. In the early years of his retirement, so if I look here, there's some withdrawals happening starting at his age 60 from his RSPs. And we look at his taxes and he's at 0% tax. So it is automatically taking out money from his registered accounts up to the non-refundable credits so that he still pays no taxes. So it's getting the money out tax-free if possible. The other money is coming here from his non-registered asset. So what is the default withdrawal strategy in SNAP projections? It is based on existing research by the CFA Institute and FP Canada. It's for efficient drawdown in retirement, and it's a tax minimization and deferral strategy. So it's using non-registered money first, and then it will use later on a blend of TFSAs and registered income. We can see that default order. Again, I'm jumping quick, but financial assets, there is another gear icon here. If I select this, I can say, show me the CFM or the cash flow management order column for this scenario. There's the option you can turn it on for all your scenarios if you want, if you always want to see this, but it does add a few columns to the page, which we'll now see. So let's look here. Sorry, just getting it oriented. Here is that new column, cash flow management order. In those first years before retirement, there is no order because we're doing manual contributions. This is before the CFM start age, like I mentioned before. In retirement, here's our withdrawal order. Non-registered first, TFSA next, registered final. And SNAP is following that order except for these extra withdrawals that are happening with zero tax implication. So this is the strategy that will be used in this case, but what if you or the client wants to make a change to that strategy? So we can change it to perhaps we want to take registered first, then non-registered, and then TFSA last. So maybe this is because they're worried about passing away early and leaving so much tax in their estate because they have a lot of registered assets. So I can copy that down. And this is going to change for Ruben and also for Hannah. Whatever you do for one spouse will do for the other spouse. Once I've made that change, if we look at the withdrawals, so now it's all registered withdrawals until that account, both of these registered accounts are depleted. Then it starts taking from non-registered. And then finally, it will take from the TFSA when it needs to. Because of this withdrawal strategy, if we look at government benefits here, previously I only had the CPP and OAS columns, but now I have a third column, which is the clawback. So by taking the registered money first, there's a higher taxable income and they're going over the threshold for OAS clawback. And now it's a part of this projection. So what I want to do is rename this scenario because we're going to do some comparisons and we're going to have multiple scenarios. Coming up to the top line here. So this is my navigation line. Getting back to my clients in the very beginning, I could go back to the client list. This is who I'm working on right now. Specifically, I'm on Ruben's page. And here's the name of the scenario, which I can just click that name and choose to rename it. So let's highlight that and change it, to scenario 1 without any tax planning strategies. So we have one scenario now, and we're going to make a second one that we can compare with. How do we make a second scenario? It is super easy. And I just need to move my Zoom note out of the way. I get to the menu here. Okay. Here we go. this menu, this is the SNAP projections menu. We can either compare scenarios from here, switch scenarios from here, rename or copy, or even delete. But let's go ahead and copy this scenario. This scenario is going to be the default. So first thing I'll do is change the name again. So click on it. Oh, I got my scenario here is going to be called scenario 2 with the default tax planning strategies. So I'm just going to go back in and turn those things back on again. So the pension income splitting was the first one, and that is only available under their individual pages to see that column. So that under the transfers here, pension income splitting, I'm going to click that and I will turn it back on. So remember that you don't have to do this in your plans. This was just for illustration to turn it off in the first place. It's always going to be on by default in your plan. So you don't have to worry about remembering to do that. So the pension income splitting is back on. We can see that happening. And notice how it's a different amount now, because before when we looked at it, we had a different order of withdrawals. Now we're taking so much money from the registered that it wasn't worth it to share as much pension income. But let's change that back to the default. So NTR for all years is the default. And I copy that down and I will run the scenario. So again, this is the default order, and it's going to give you a really efficient starting point for your projections. So the default withdrawal order and pension income splitting turned on by default, and we'll be able to compare how that how much of a benefit is that compared to the one where we didn't have the default strategies. So let's take a look back at the slide for a second here. So scenario 1 is without default, without any tax planning strategy. So one thing is that the marginal tax rates were kind of inconsistent, and we also had OAS clawback. Scenario 2, we're going to have pension income splitting on, and the decumulation strategy is set for tax minimization and deferral. So the last scenario we're going to create is with additional tax planning strategies. So what are some other things that we could consider for Hannah and Ruben? Well, what about those pre-retirement contributions? Maybe we can make some adjustments there. We can have a target annual taxable income in retirement. So maybe want more of a blended withdrawal with some registered money and some non-registered money. We can look at topping up the TFSA later into retirement. We can look at tax loss harvesting and some in-kind charitable contributions. So if we come back to SNAP again, let's go ahead and let's take a look at scenario 3. So we're going to copy this scenario. So scenario 2 again, I will choose the menu and copy scenario. And this time, okay, I'm going to call it scenario 3. So I'm just copying that name from my other screen here. And we will click on this name and rename it. So the first step, what we can try is adjusting those pre-retirement contributions. So for Hannah, if we remember, she had, scrolling over to the right here, we have TFSA contributions of 7,000 and RSP of 20,000. What if we reduce the TFSA by $3,000 and make this a $4,000 contribution? Actually, before I do that, just a quick review of what her what's left over right now for spending is about $53,000, $54,000 the first couple of years, and her marginal tax rate's of 43.41%. Just to compare in a moment when we make this change. So we've got $4,000 instead. So we're reducing it by $3,000. And we're going to increase the RSP contribution by $5,000 to $25,000. So recognizing that she's going to get a tax deduction for a higher RSP contribution, and this is going to be pretty much the same leftover spending that she had before because she's saving some money on taxes, but she's still within the same marginal tax rate. So she's kept her after-tax spending the same, but just adjusted slightly where the money is going. So the next one we can see in her first few years of retirement here. So her tax rate has dropped significantly in these first few years because we're just taking the non-registered money. She also does have her pension, but yeah, remember our order now, our default is the non-registered first. So a really quick way to get a blended withdrawal and kind of not jump so low in the tax rate in these first few years is to adjust when the RIF income starts. So right now it's starting at age 72 because, well, actually the minimums are starting here at age 72. And just by hovering my mouse over, I get more detail. So in the year 2042, it is a RIF because I can see that there's a minimum withdrawal that has to be taken. The year before that, there is no minimum withdrawal because it was still considered an RSP. It can still withdraw money from that account, but it's not considered RIF income at that time. How to get to that, how to tell the software that it would be a RIF then, we can go back to scenario setup, or a quick shortcut is just to click financial assets, the header there, and it takes me right to the page that I want. I'm going to go to the RSP RIF page, going to change the conversion age to 59 and do the same for Ruben. So back to his RSP, he has two of them. So again, 59 for both of those. And that's 3 accounts switched to, to switch to RIF earlier. So whatever page we're on in scenario setup. So I was on Ruben's page. That's where I come out to the planning page. And now we can see that it is taking these minimum withdrawals right away from both his personal and his group when he turns 60. So the conversion age of 59 means that the income will start at age 60. The next thing that we can look at would be in-kind donations. So instead of the cash donations for Hannah, so I have to switch over to Hannah's page here. So for Hannah, we have the charitable donation column, which here's those cash donations. By switching the view here, that's one thing I didn't mention. There's these little arrows. I can switch the view, and that tells me some different things. So total donations and the claimed amount. So right now she's, well, it's being claimed every year. So some years it won't claim it if it makes sense to wait or to transfer it to the other spouse. I also can click the donations menu, I guess, here. So it opens up the table, and there's a lot more details about how much taxes they're saving by making those donations. So what would their total tax be if they made the donations versus without the donations? It also would show any claimed amounts. So for example, if Ruben was making the claims, you would see that here instead. So Snap will look at which spouse it makes sense to do the claims for. Back to the other view where I can make the edits. In these first 2 years, I'm going to zero out the donation that Hannah is making as cash and scroll over to her non-registered account. And there's a donation column that I can add a $10,000 in-kind donation from this non-registered account. So it's not the same column as a withdrawal, it's an actual donation column. And then that means that it's going to liquidate the appreciated security, but it won't realize the capital gain because we're in this case anyway, that there was the calculation works out so that it's going to be more tax efficient to do it this way. So those financial asset donations are displayed here, and you can see that it's still being claimed in that year. So 2 more things, and then we'll take a look at the comparison. So we've got the portfolio settings. So what are portfolio settings? Under scenario setup, we have settings. Down at the bottom, portfolio. So these settings are for our non-registered portfolio. It's looking at how would the taxable income be comprised for this non-registered account for the equity portion. And you can adjust how much is capital gains, Canadian dividends, foreign dividends. And then this is the one we're going to talk about right now is the portfolio turnover. So by default, it's realizing 5% of capital gains each year. We can reduce that, say, to 2%. So this could be used for tax loss harvesting or corporate class funds, for example. And it'll just model it a little bit more closely. So we're at 2% instead of 5%. And one last thing. So on the planning page, just to highlight to you too, like to know more about the taxable income, we do have all this detail, taxable income detail. And this is where you can see all about the investment income for the non-registered assets, interest, foreign dividends, Canadian capital gains. So this is where you would look when you make changes to the portfolio settings, just to see what the changes, how they look out here with regards to taxable income. The last thing we're going to do for both of them is continue making TFSA contributions to their TFSAs just until age 69. So they still have non-registered assets that they can move money out of and into the TFSA for those years. So it makes sense to do that. Let's get the money into the TFSA for Hannah and then also for Ruben. And TFSA here. And we'll just again go to 69. All right. So this is our third scenario. We finished making the updates. And now the question is, well, was that an improvement or not? How does it look? We can scroll down to the bottom and just kind of take a quick look at this final year, what's left in the all types, or again, look at the estate summary. But the tip here, clicking this menu next to the scenario name to compare scenarios is what we're going to do. So this shows us just for this one scenario, but we can click the menu up at the top and choose compare scenario. And then you'll notice that I can choose just one scenario if I want to. So if I want to compare, it's like comparing one scenario. Really what it's just going to do is give you a lot more detail about that scenario's metrics in this view that we're going to look at right now. But I'm going to look at all three. But just so you know, if you ever wanted to do it with just one scenario, it's still possible. We have all of our scenarios from scenario 1, 2, and 3 here. So scenario 1, the first one, we're reaching our goal. So our goal was to retire at 60 and spend $108,000 a year. We were above that goal. So we didn't run out of money before the end of the projections. But just with Snap's default tax planning strategies, you can see there's a big jump already that now we're at 113% of our goal. By making some minor tweaks, we got it a little bit higher, 115%. But the biggest jump here came from just the default tax planning strategies. So even if you aren't going to go into this level of detail, you're still ahead of the game with the defaults. There's a lot of things to look at here. You can make changes to when you're reviewing these metrics from. So you could look for just 1 year. Right now, we're looking for the length of the projections. You can look at the values in nominal or real dollars. And you can select different scenarios to compare. Select metrics to show. So this would allow us to choose which of these metrics do we want to actually see in this table. We'll just keep what we've got right now. And at the top here, we've got the primary ones, which tell us a lot about what their lifetime expenses, the personal tax, lifetime corporate tax, and so on. And then the personal estate. So this is probably the one, sort of the final line. What's their estate before tax in each of these scenarios is probably what they're looking at. But how does it change over time? So this is the final year of the plan. We can use what's called trends to see over time, how does this change? And here we've got the personal estate after tax. This metric shows us the 3 different plans. And if I get my mouse away for a second, you can kind of see the table a little bit better. But we've got scenario 3 with additional tax planning strategies wins out after about age 75. The basic one without any tax planning strategies is a bit better up until about age 75, but then drops off pretty significantly. So the longer they're going to live, it is better. They're better off for their final state to go with scenario 2 or 3. You can print this as a PDF as well. So that is another option, or include it in your report. And I just noticed that like our time is very close to the end here. So I went into more detail probably than Alex was expecting. So let me just finish up. One last thing, show you that there is a client report because you want to be able to show your clients this information. Into the report builder is where I can select which pages I'd like to include in my report. Comprehensive report is definitely possible. You can see all these pages that we have available to include in your report. I just want to show you a quick snapshot only view, which is a one-page summary. Got a click here for snapshots only. This is the page that I can use to select or deselect any of these pages. I'm going to remove a few just by dragging them out. The assumption summary, the expense summary, the estate summary, and the recommendation summary. And I'm just going to leave 6 so that when I take a look at my report editor, I can see that those 6 I've included with my goal summary. Right now, I see the template that's available for me, and I can enter in extra lines if I wish that use these template variables. So I could say the goal summary is additional travel, and I at let's say Hannah's retirement age, so I can choose at age 60 and or year retirement year, Hannah. So the great thing about these variables is that they're going to be automatically updated in your projections so that any change you make in your projection, if you change to retirement age, it's automatically going to update in your report. So you don't have to come in here and make any other changes. The goal status and so on is going to use information from my planning page. So because in this case, they're going to have more money than they needed for their goal. If I was to calculate something like their retirement age to say they could retire earlier because they have more than enough money to meet their goal, what age would that be? So Snap is going to tell that to us by doing automatic calculation. So they could retire 2 years earlier than what they planned, or they can spend less in their projections. So when I calculate these recommendations from Snap, it's going to be part of my report if I want it to be. So they could spend a bit more. And in the client report, that goal status is going to fill out automatically with those recommendations. And so what does the final report look like? My final report here is one-page summary, a quick view, snapshot, show your clients where they're headed and yeah, like how their goals are shaping up. A lot of these updates and tax updates and tax considerations that I put into the plan today recognize that we're going to be working on more of these to be automated. So we want to make it easy for you to quickly quickly look at the taxes and optimize things efficiently, but still have the same degree of control and customizability that you're used to with Snap. And there are so many things we didn't cover, but our team is here to help. We have such a huge knowledge base, training, and so on that go into much more detail than I did today. So, Alex, I'm going to pass it back to you. And sorry I took up so much time.
Wonderfully. Thank you so much. Yes, so we are at the end of our time here. Just a few quick things we are going to run through. There are still 160 advisors here, so clearly everyone is enjoying your presentation, Lee. But we will be quick here, just to respect everyone's time. So, special offer for those of you here live with us today who would like to set up a free trial of Snap and try to implement some of the things you have learned here today. We are going to give a special gift to every single advisor who signs up for a free trial of Snap Projections today. Each one of you who starts before midnight Eastern time today will receive an extended 1-hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template. just as you saw Lee do here a moment ago. The snapshot is very flexible, but it's most often used in three different ways. It can be used as a standalone client deliverable that essentially replaces the longer client report. That's the example that you're looking at now, and the example that Lee just put together. You saw it was just a few clicks, a few seconds, and that was produced. So it's no additional work for you to pull this one-page report. It's also very often being used as a 1 or 2 page quarterly or annual review, and it can be used as the executive summary to the full comprehensive report. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one-on-one to create your template so you can instantly pull a 1 or 2 page report from your projections. On our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. The advisor business plan is the one you want for the corporate module. You can upgrade and downgrade anytime, so don't worry too much about which one you select today. I have dropped a link in the chat. You can open that up now. That is how you can register for your free trial and ensure you take advantage of the special gift being offered today. And I am going to send this out via email as well. You'll get instant access to the software when you sign up. You don't have to download anything. It's web-based, so you can really hit the ground running instantly. And for those of you here today who are already using Snap, thank you so much for being here today and being a part of our valued community. A reminder that you can be earning free months of Snap when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of Snap, and the referring advisor gets an entire free month of service when the person they sent our way becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. There's no limit on how many times you can do this. We have created a new referrals page that you can access from within your Snap account that makes it easy to take advantage of the Snap referral program. So with that, typically we would move on to our Q&A session. We have gone over a little bit. I'm just wondering, Lee, if we can cover one thing very quickly because we had a whole bunch of questions surrounding the CFM. So the cash flow management, we've just had some questions on how does it work? How do you access it? How are the withdrawals handled? But also
Okay.
how are the contributions handled?
Okay.
And can you make manual changes to override the default? So we can cover about 6 different questions, hopefully pretty quickly here.
Okay. So yeah, so cash flow management, and we have a video on this as well, but in general, we've got this column. This is controlling the cash flow management. So I'll just use starting at retirement here as an example, but let's say maybe that there was more income coming in retirement, uh, extra money coming in. So how does a contribution work? Let's make it bigger than that. So the contributions are going to work by following the default order. So for RTN, and scrolling over, we can see that we've got now some contributions happening. So why is there some in the joint? Oh, because we set the RSP to be a RIF. We can't contribute to that. One second, let me change it back quickly. So what will happen is for Hannah, if I made that back to 71, now there's still going to be the ability to make RSP contributions. So this setting is going to be first in line. So it knew before that it was a RIF, and it couldn't make the contribution. Let's see, 200,000's coming in, defined benefits coming in. Let's just start it in the beginning because It's easier to know. And that's what you can do. You can say if they know their expenses right away from the beginning of the plan, then this money is coming in and it's going to follow the default order. But you can still make your own settings. So if I take out my override of my 25,000 manual contribution that I made, now it's going to be an automatic contribution. So Snap is going to say, there's surplus money left. Where are we going to put it first? It's going to go to the RSP. But it also is going to make that 4,000 TFSA contribution because I have an override. So this is where you can do both things. You can do manual and automatic things at the same time. So same for withdrawals. If you said, I don't want money to come out of this account, I could put a 0 and say, don't take anything out of that joint non-registered. And it's going to then take money from the next asset in the list. Similarly, you could say, do take money from my RSP. So maybe negative 20,000. I want to start taking money, but I don't want to make it a RIF. So you have control using these overrides that you can sort of force different things than the automatic cash flow management is going to do.
Perfect. Thank you so much. Okay, so the rest of the questions I am going to follow up with everyone over email just to be respectful of everyone's time here today. So thank you so much, everybody, for being here. All of you that were here for the session live today will receive an email tomorrow with the video recording as well as the form to fill out to request your CE credit. I will send a few follow-up emails as well. I'll be sending out everybody the link to take advantage of the special gift with the free trial offer today, and we will follow up with you from there. So thanks again. Enjoy the rest of your day, everyone, and we will talk to you soon. Bye for now.